I think this is really a movement. It's driven by the deplorables in the U.S., the disaffected middle Americans. They can see what's going on with the financial system, and they're departing the financial system by purchasing assets that are held outside the financial system as the volatility increases and as the currency becomes destabilized by central bank policy.
Physical silver and gold in your hands, personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com. Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And with us today is David Jensen, mining executive and metals analyst. David, thank you so much for joining us today.
Hi, Elijah. Great to be with you.
It's great to have you. And yeah, the first topic I'd like to discuss is what's been happening in the silver market for the last month or so, ever since this SilverSqueeze, right? Miles Franklin has had its busiest month ever in 30 years of history. And we're just seeing so much physical demand for silver, yet we're seeing the price fall back to pretty much where it was before this all started. What do you make of what's happening right now?
Well, it's very similar to what we saw happen last year in the physical market during the COVID panic that was started. There was a tremendous purchasing and investment of silver, both industrial users stockpiling and investors buying. And during that period, the first 6 months, the price of silver actually fell. And so the big question is how, on a supply-demand basis, if you have proper price discovery, how can you have falling prices as you have skyrocketing demand that all of a sudden arrives in the market? And we've seen something quite similar this year. We did have initially a price surge in January, February, but it's fallen back now, even as we're seeing the lease rates in London jumping for the 1,000-ounce bars there. That's the world's primary silver market. And we're seeing, premia being paid in the U.S. $1.25, $1.25 an ounce for a 1,000-ounce bar. So incredible premia, 4 to 5 times historic levels. And the only thing I can attribute it to is the fact that you've got two markets. One is the physical market, and then you've got the digital trading market where they're trading unallocated contracts or futures contracts that don't have anything actually backing the contract. So, but what does happen, and this is the thing for people looking at this market to consider, is that with palladium, for instance, in 2016, we had a run on palladium and the lease rate started to jump up in London. And then you had a 4 to 5 times price move after that. And the reason that it can happen, even with the digital trading of palladium and platinum in London, is that once you get physical shortage in the market, it prevents the containment of prices by offering into the market digital units, thereby distorting the price discovery process. Because adding these digital trading contracts into the system creates supply where there is none, and you can use it to flush out the market or blow the stops of the traders and cascade down the price.
Now, you mentioned the premiums on the 1,000-ounce bars. Can you share with the viewers kind of the significance of this? Have we really seen the premiums at this level before?
They are very high premia that are being demanded, and there have been, for many of the purchasers, there's been delays as well. And this is typical when you have a shortage, and I think we've seen these types of shortages back in the 2010, 2011 period, where the price was heading towards $50. But what's strange here is that we had the initial surge at the beginning of the year, and then the price has fallen back now. Really, if we look at the backstory of this whole thing, there are some analysts that say that this is really a temporary squeeze with the Wall Street bets crowd and retail investors buying retail investment products. But if we look at the big picture and look back to last year, we had over a 300 million ounce increase in the purchasing of silver, both by ETFs and by retail investment product purchasers. So there is a very, very real physical demand underpinning this market. And I think as we see the premia rise and we see the lease rates rising, indicating further market shortage, that it starts to contain the ability to set price with digital trading instruments.
You mentioned how it's really the movement we're seeing is more than just this silver squeeze phenomenon. It goes back before then. You've said that people are wanting to get outside the system, right? And they're taking delivery of something that's real, physical precious metals. Can you expand on kind of the movement we're actually seeing that is a bigger movement than just the movement we've seen in the last month?
Sure. I mean, if we look back to the 1970s, which was the last time that we had, gross monetary inflation by the central banks of the world, you had gold put on a 20 times price move in 9 years, as did silver. What happens is when you dilute the currency and essentially abuse the currency with that level of currency creation, is that investors know that consumer goods price inflation always follows that level of currency increase. What we're seeing is that, and it's not just silver, copper's up over $4 now, and lumber's at all-time highs. And so you're seeing the things that you can't print start to jump in price as observant investors who are still, they're just at the margins in terms of the total market out there. But they provide enough additional purchasing of these assets to drive the price higher on a shortage basis. So I think this is really a movement. It's driven by the deplorables in the U.S., the disaffected middle Americans. They can see what's going on with the financial system, and they're departing the financial system by purchasing assets that are held outside the financial system as the volatility increases and as the currency becomes destabilized by central bank policy.
You mentioned the currency and the money supply, right? And you actually just tweeted about this, how looking at the M2 money supply, it looks like we're actually headed towards another financial crash. We saw a similar thing happening with what's happening right now before the 2000, the dot-com bubble, and before the 2008 crash.
Yeah, so the Federal Reserve is legging up again on money creation. It's about $3 trillion since they've added to the system since January of 2020. So a little bit over a year, they've added $3 trillion of liquidity. And these are the signals that are being watched by industry and by private individuals in terms of needing to get things that aren't diluted as these digital assets that are being created by the Fed are. It's strange the amount of liquidity that they're injecting, but we're starting to see instability in the stock market. It certainly looks like it's rolling over. We've had the euphoria phase in many of these tech stocks, and it looks to me that we're heading into a period now where people are going to seek shelter by buying real assets and trying to lay a foundation for stability through a very unstable time ahead.
How do you think this will impact the price? Because if we look at what's happened to the silver price in the last month, as we've seen a huge amount of demand for retailers, it hasn't been impacted that much. So do you see this demand that's coming to impact the prices of gold and silver?
Yeah, last year we saw more than 200 million ounces of silver investment purchases happen while the price of silver actually fell. And then the system was tightened up enough that it actually forced the price up, that these digital trading instruments lose their effectiveness in price containment. And I really think that that's what we're going to see now, is that we're taking up the slack. And it's been a heck of a jolt, Elijah, since the beginning of February that has hit the silver market. And there's been unprecedented demand. Just the Sprott PSLV physical silver ETF, on average, they're adding about 1 million ounces a day, plus or minus per trading day, into their ETF. And if you look at on a trading day basis, the amount of silver that's mined globally, it's about 3.2 million ounces a day. So there's one ETF alone, which is actually taking the bars and putting it in their vaults. Then you add on we call it the Wall Street bets, but the deplorables buying silver and getting assets out of the financial system. And it's putting on a heck of a lot of stress. And we're seeing it now in London, whereas we didn't see it last year in the same way. There was not a surge in the leasing rate, which is the cost to borrow silver. And we're seeing it surging now, indicating that there's actually in London, in the 1,000-ounce bar physical market in London, that the shortage is hitting there in the world's biggest market. So I think we've got a pause here, but I think that the slack is being taken out. and that the investment purchasing that we're seeing is fundamental. It's people buying bars and coins, and some ETFs are loading up.
Now, you mentioned how people are waking up and realizing that, a lot of money is being created, and for that reason, they want to protect themselves, right? Buy something that has intrinsic value, something that's actually been money and had value for over 5,000 years, which is gold and silver. Right. A similar thing happened leading up to the 1980 bull market, when there was a lot of inflation. People were worried about the value of the dollar. And you've noted this and really said this whole idea that the Hunt brothers bid up the price of silver, that's actually not 100% true. It's more that people were concerned about inflation and they wanted to buy precious metals. And that was the real driver for that bull market.
Yeah, it was monetary inflation by the central bank that drove it. I mean, the Hunt brothers didn't drive up soybeans. They didn't drive up gold. They didn't drive up oil. They didn't drive up timber and timberland. So these assets absolutely crushed the market in terms of the price inflation we saw in them in the 1970s. The loose monetary policy of the central planners at the central bank is back. They can only maintain a show for so long before they have to engage in their money printing in a very open and I think it's extraordinarily damaging to society, the fashion in which they do it. So we're seeing, I think, a very similar situation. I think it's manifold times greater because of the level of debt that we have in the system with the price containment of gold and silver that we've seen since the LBMA was formed in 1987 in London. It essentially turned off price discovery or crimped the price discovery to the extent that it allowed central banks to run extraordinarily loose monetary policy for decades, while gold and silver, which are the warning systems for loose monetary policy, didn't respond. Very, very disturbing in terms of global debt now is over $300 trillion. And now we have starting to increase rates and devastation brought to the economy by the government shutdown for the COVID terror, which was operated last year and now into this year has been just horrific. So, I think that the time for these assets is back again. And we have at this exact same time an unwinding of so many different aspects in the market in terms of illegal activity. Let's just say modulating activity that's been used to contain the price in the past. So we could have some very, very shocking increase in prices of many raw materials that have been underpriced because of these trading systems that have been used.
Now, the movement that we're seeing into real assets, because of the movement really created by this fear of inflation, right? This fear of the devaluation of the currency has also led some people to look at Bitcoin, an alternative currency. What are your thoughts on that? Do you think Bitcoin is as good as gold?
Well, if you look at Aristotle's definition of money, and money is very different from currency, but Aristotle had, four primary characteristics of money that gave it enduring value. And one of the characteristics was that it had an asset of intrinsic value was at the center of it. And with the naked cryptos, such as Bitcoin, when you look at those assets, I really look at cryptos as kind of magic beans, and they have value as long as you think they have value. They have increasing value, or they maintain value as long as there's additional people entering into them and buying in on the theory of them. But the four characteristics are durability, portability, divisibility, and then intrinsic value is the fourth one. That's the critical one, that the intrinsic value is what the crypto magic beans don't have. And I think it's a horrific thing that's happening with the promotion that's going on, because investors are being led by the nose into another scam after being scammed so many times over the decades with the tools of central banking and the monetary inflation that's gone on and debt-based growth. That has really distorted and I think greatly destabilized things. So, no, I'm not a fan of cryptos, and I think it's going to end very badly for those who are dragged into it.
Some people do argue that they do have intrinsic value because of the system that they're built on, the blockchain, the whole blockchain itself to have intrinsic value. But your argument is saying there is no intrinsic value. And in that case, do you see them falling to zero?
Yeah, I do see them going to zero. I mean, if you look at the trading networks, you could say that you could create a trading network with any commodity of which there's a great deal of stock above ground to modulate the amount that you can increase it. And gold and silver are the two that you can only add so much to the above ground stock of the metal on an annual basis. But it's because it doesn't have intrinsic value backing it. It's really a theory, and you're really buying into a craze. And it does go up, and it goes up, and it can go much higher. I mean, it could go to 100,000 or $500,000. I don't know where it stops. But the fact that you've got a trading network is nothing special. And the second thing is that if you look at Bitcoin in terms of the energy consumption to do a single transaction is over 700 kilowatt hours of energy just to do the transaction. I'm not talking about mining Bitcoin. I'm just talking about the transaction energy that is utilized by the system in the blockchain when you do these transactions. And so it's not, you can't possibly hope to start a transactional currency out of a unit that uses that level of energy. So it fails in so many levels. And to say that there's a network there's nothing special about a network. You can create a network of anything and then back it with a real asset for exchange. So you don't need to have a naked crypto and to have that as a unit of currency or of a unit of value. It's a theory. And I think when people start to look at this stuff and scrub it down a little bit, it falls apart pretty quickly.
Some people have said that the movement into cryptocurrencies has drawn away momentum into precious metals. Do you see that if the cryptocurrency space does collapse, that could then push a lot of those people who are in that space looking for an alternative currency back into precious metals? Yeah,
I mean, if you look at the Wall Street silver movement, maybe there's 35 or 40,000 people in the subreddit and some of the other communication fora for the discussion about silver. So it's a space which is nowhere nearly fully occupied currently in terms of investment interest. And it's still very much at the margins. And I think that's what, Elijah, is so notable about it is that, we're really in the weeds of the monetary world and the investment world in terms of analyzing this stuff and awareness of this stuff. And even with that small amount of awareness, we've seen this incredible. I mean, if you've got a 1 billion ounce per year market in silver and it fundamentally increases, you see a fundamental increase in the demand of 300 million plus ounces as you saw last year. And it looks like we're going to leg up from there this year as more and more awareness comes to the value of these wealth protection and current monetary unit assets. But, I think we're going to see an incredible move. But my concern is that the market at some point has a failure because of the supply versus the demand, and that you might go bid no offer at some point because of the instability that's built into the market now. So we'll see where it goes, but it's not all going to be fun going forward with this space here, given where we're at after all these years of monetary system abuse.
All right. Well, David Jensen, we really appreciate your time today. Before we let you go, if our viewers would like to watch more interviews like these, definitely hit the subscribe button and the bell icon so you'll be notified of all the new videos we're producing. Where can our viewers find you online and follow your work?
Probably the easiest is on Twitter, @RealDavidJensen, JENSEN. And I post thoughts there and I post the odd article on LinkedIn and some other places. So be able to track me down that way, but @RealDavidJensen is a good starting point.
All right. Any last thoughts you'd like to add, David?
No, I just thank you for the time. And I think we're in for an incredible move in this market here. And it's been, as I noted, just really surprising seeing the amount of metal being swept away last year. And then now again, legging up this year, given that there are still so few people that are aware of the, of the positive attributes of silver and gold and other real assets. So it's quite something to see. It's disconcerting, but we can only do what we can do and talk openly and fairly about it, and hope we can restructure things with a more fair and more balanced system. So we'll see where it goes.
All right, David Jensen, once again, thank you so much for your time, and God bless.
Thank you very much, Elijah.
physical silver and gold in your hands. Personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com.